Hello and welcome to the Investing Iguana, where we help you make smart and informed decisions about your money. I'm your host, Iggy, and today we're going to talk about one of the hottest stocks in the market right now, Nvidia. Nvidia is a leading company in the field of graphics cards, artificial intelligence, and gaming. It has been on a tear this year, with its stock price nearly doubling from around $150 in January to over $300 as of May 2023. But is it too late to buy Nvidia stock? Or is there still room for more growth? That's what we're going to find out in this video. We'll look at the latest analyst ratings and price targets for Nvidia, as well as the company's recent earnings report and outlook for the future. We'll also compare Nvidia to its main competitors, AMD and Intel, and see how they stack up in terms of performance and valuation. But before we dive into the details, please make sure to hit the like button and subscribe to our channel for more investing tips and insights. And don't forget to turn on the notification bell so you never miss an update from us. Alright, let's get started. Analyst ratings and price targets. One of the first things we like to do when evaluating a stock is to check what the experts are saying about it. According to MarketBeat.com, Nvidia has 38 analyst ratings as of May 2023, with an average consensus rating of moderate buy. This means that most analysts are bullish on Nvidia and expect it to outperform the market. The average analyst price target for Nvidia is $270.97, which implies a downside of 13.33% from the current price of $312.64. However, this average is skewed by some outliers who have very low or very high price targets for Nvidia. For example, Sanford C. Bernstein has a buy rating on Nvidia with a price target of $355, which is the highest among all analysts and implies an upside of 13.57% from the current price. On the other hand, Zacks Investment Research has a sell rating on Nvidia with a price target of $133, which is the lowest among all analysts and implies a downside of 57.46% from the current price. So, as you can see, there is a wide range of opinions on Nvidia among analysts, which reflects the uncertainty and volatility of the stock market. However, if we look at the most recent ratings and price targets, we can see that most analysts have raised their expectations for Nvidia after its impressive earnings report in April 2023. For instance, Oppenheimer boosted its price target on Nvidia from $300 to $350 on May 18, 2023, citing strong demand for its AI chips and gaming products. Truist Financial also increased its price target on Nvidia from $289 to $322 on May 10, 2023, noting that Nvidia is well positioned to benefit from the secular trends in cloud computing, data center, gaming, and autonomous vehicles. So, based on these recent analyst ratings and price targets, we can conclude that Nvidia is still a buy for many investors who believe in its long-term growth potential and competitive advantage. Earnings report and outlook. Another thing we like to do when evaluating a stock is to look at its financial performance and outlook. Nvidia is expected to its fiscal 2024 first quarter results on May 24, 2023. The company is expecting revenue of $6.8 billion, which should beat consensus estimate of $6.5 billion by 4.6%. This was also a 21% increase from the same quarter last year, despite the challenges posed by the global chip shortage and the weak PC market. The company also delivered earnings per share of 98 cents, beating the consensus estimate of 92 cents by 6.5%. This was also a 32% increase from the same quarter last year, thanks to its strong gross margin of 57% and its efficient cost management. The company attributed its strong performance to its diversified portfolio of products and platforms that cater to various high-growth markets such as gaming, data center, AI, automotive, and professional visualization. For example, its gaming segment generated revenue of $3 billion, up 27% year-over-year, driven by strong demand for its GeForce RTX graphics cards that enable ray tracing and other advanced features in games. Its data center segment generated revenue of $2 billion, up 18% year-over-year, driven by strong demand for its AI chips that power cloud computing, machine learning, natural language processing, computer vision, and other applications. The company also saw growth in its other segments such as automotive and professional visualization, which generated revenue of $300 million each, up 12% year-over-year and 21% year-over-year respectively. Looking ahead, Nvidia expects revenue of $6.5 billion for the second quarter of fiscal 2024, which would be a 3% increase from the same quarter last year. The company also expects gross margin of 64.1% for the second quarter, which would be lower than its first quarter margin. So, based on these earnings results and outlook, we can conclude that Nvidia is still growing at a fast pace despite the headwinds in the industry and that it has a positive outlook for the future. Comparison with competitors. Nvidia's main competitors are AMD and Intel, which are also involved in making chips for PCs, data centers, and other markets. However, Nvidia has a clear edge over them in terms of innovation and market share. For example, Nvidia's graphics cards are widely regarded as the best in the industry, especially for gaming and AI applications. Nvidia has a dominant market share of 81% in the discrete GPU market, while AMD has only 19%. Nvidia's GPUs also support advanced features such as ray tracing, DLSS, and CUDA, which give them a performance boost over AMD's GPUs. Nvidia is also ahead of Intel in the data center market, where its AI chips are in high demand from cloud service providers and enterprise customers. Nvidia has a market share of 75% in the AI accelerator market, while Intel has only 15%. Nvidia's AI chips are also more powerful and efficient than Intel's chips, which are based on older architectures and technologies. Nvidia is also expanding into new markets such as automotive and edge computing, where it is leveraging its expertise in AI and graphics to create solutions for self-driving cars, smart cities, robotics, and other applications. Nvidia has partnerships with leading automakers such as Tesla, Toyota, Mercedes-Benz, and Volvo, as well as with cloud giants such as Amazon Web Services, Microsoft Azure, and Google Cloud Platform. In terms of valuation, Nvidia is more expensive than AMD and Intel, but that's because it has higher growth rates and margins. Nvidia has a trailing P/E ratio of 179.68, while AMD has a trailing P/E ratio of 397 and Intel has a trailing P/E ratio of 12.01. However, Nvidia also has a trailing revenue growth rate of 21%, while AMD has a trailing revenue growth rate of -9% and Intel has a trailing revenue growth rate of -36%. Moreover, Nvidia has a trailing gross margin of 56.93%, while AMD has a trailing gross margin of 46.19% and Intel has a trailing gross margin of 54.76%. So, based on this comparison with competitors, we can conclude that Nvidia is still the leader in its industry and that it deserves a premium valuation for its superior performance and prospects. And just in case you are unfamiliar with what a trailing revenue growth rate is, a trailing revenue growth rate is a measure of how much a company's revenue has increased or decreased over a certain period of time, usually a year. It is calculated by taking the difference between the current revenue and the revenue from the same period a year ago, and dividing it by the revenue from a year ago. For example, if a company had revenue of $100 million in 2022 and $120 million in 2023, its trailing revenue growth rate for 2023 would be $120 million to $100 million / $100 million equals 0.2 or 20%. A positive trailing revenue growth rate indicates that the company's revenue has increased over the past year, while a negative trailing revenue growth rate indicates that the company's revenue has decreased over the past year. A trailing revenue growth rate can be used to compare a company's performance with its competitors or with its own historical performance. To sum up, Nvidia is a great company with a strong track record of innovation and growth. It has a diversified portfolio of products and platforms that cater to various high-growth markets such as gaming, data center, AI, automotive, and professional visualization. It also has a loyal customer base and a dominant market share in its core segments. The company delivered impressive earnings results for the first quarter of fiscal 2024 and expects to continue growing in the second quarter. The stock price has nearly doubled this year, but it still has room for more upside according to some analysts who have raised their price targets after the earnings report. The stock is expensive compared to its competitors, but it also has higher growth rates and margins that justify its premium valuation. Therefore, we believe that Nvidia is still a buy for long-term investors who believe in its vision and strategy. However, we also advise caution and diversification for short-term investors who may face volatility and risk in the stock market. That's all for today's video. Thank you for watching the Investing Iguana. If you enjoyed this video, please hit the like button and subscribe to our channel for more investing tips and insights. And don't forget to turn on the notification bell so you never miss an update from us. We'll see you next time on the Investing Iguana. Until then, happy investing.